Welcome to SB Talks. Today is Tuesday, November 12th, and I am joined by former RBA Governor and Stanford Brown Investment Committee member Ian Macfarlane. Welcome, Ian.
Thank you.
Today, Ian and I will be discussing the recent election of Donald Trump and what it means for the world economy. We'll have discussion on some of his policy platform and what this may actually look like, as well as the longer-term threats to economies and markets. Welcome to all our listeners. There is one topic dominating headlines and markets, and I'll open by asking, what does the election of Donald Trump mean for the world economy?
Well, there's no doubt that it was a huge event, and in fact has been probably the biggest economic event in recent years. And there's no doubt that it increases the risk to the world economy.
Perhaps have a lot of things to take away from this election, but that probably puts it into context. How did they lose such a substantial portion of their voter base in such a short period of time?
I don't know that I could answer that. Well, the obvious thing is they had a very weak candidate. That's the obvious one. A candidate that would never in normal circumstances have ever found themselves actually running for president. But I won't go any further than that. I think the Democrats have got problems that are much, much deeper than that. They have tended to alienate their traditional followers and lost them.
No doubt, and that Central American base has been absolutely surrendered.
Yeah.
You talked, as we opened, about this is seismic, and there's things to consider both in the shorter term and then very significant items in the medium to longer term. It can be difficult to unpack what would be a Trump agenda, because there's, fair to say, a lot of hyperbole and a lot of things put out there. But before we even start trying to work out what policies could be put into effect and which won't, maybe you could take us through what are some of the main policies that would have significant impacts.
Yeah, thanks. The main policies are, number one, to raise tariffs on all imports between 10 and 20%. To raise tariffs on China, imports from China, by 60%. To reduce immigration, legal and illegal. To deport 20 million illegal immigrants. I don't know how they're going to do that. To lower income taxes and company taxes. And to replace Jerome Powell as chairman of the Fed by someone who is more likely to be sympathetic to lowering interest rates.
No doubt you would have enjoyed the Q&A with Jerome Powell last week, where he was asked just about that. Maybe just quickly ask your opinion on that, the likelihood of that specific individual item?
Well, he was asked, his term as chairman does not expire until mid-2026.
So he was keen to point out that there's no legal grounds for his removal.
Yeah, and he well, the first thing is, they said, would you go if you asked? And he said, no. And then they said, could you be removed by the president? He said, no, he does not have the power to remove me, both of which are correct. So there's going to be a tension going forward. If the policies are as inflationary as I think they will be, there's going to be enormous tension between the administration and the Fed. So
as you set these policies out, some, let's dare I say, quite a bit more radical than others. Now there's one scenario which is having a policy, there's another one being able to actually implement it. In his previous term, he was only able to implement a portion of his policies. Debates over whether he actually believed in his policies or not, but what actually manifested was more of a subset. What's your thoughts around this time, and what might make its way through onto the actually implemented agenda?
Well, I think during the past year, most people assumed that Trump was the most likely winner of the election, because the Democrats had got themselves in such a hopeless position. But we didn't know. What we didn't know was that they were going to sweep both houses of Congress, and so that really means that the capacity to enact your agenda is so much greater than it was last time. The U.S. Constitution gives the president almost monarchical powers, and that's not surprising, because it was written at a time when most forms of government were monarchies. The difference between the president and the king was that the president had to get elected. That was the big difference. But they had powers almost as great as a king. But they also had two checks and balances. And the two checks and balances were the Congress. Well, that's not going to be much of a check because the Republicans now control both the House of Representatives and the Senate. And the other check and balance is the Supreme Court. And as a result of the accident of judicial retirements, nearly all the members of the Supreme Court are Republican appointees. So obviously there's a much greater capacity to achieve the agenda than there was last time.
Now, we talked a little bit at the outset around short-term implications and then longer-term implications. What do you mean by this?
Well, I think the thing that's common to both the short-term and the long run is that the policies will be inflationary, much more so in the long term than the short term. Now, in the short term, we know a bit about what's going to happen because we've already seen the markets respond. And so the markets responded, as you would think, I suppose. They responded by share prices went up, and so did bond yields.
Yeah, the long-term bond yields in preparation for Trump presidency.
Yeah. So this is not all that surprising. The sort of expansionary policies that he has in mind in the short run would pump up the economy a bit more. Tax cuts, obviously, income tax cuts, company tax cuts are going to be very expansionary. Company profitability in the short term will probably rise. A lot of industries that compete with imports will find themselves in a much stronger position than they were before. So it's not surprising in that sense that we've had this market response. These sort of policies, expansionary policies, are actually easy to do, and they will always give an economy a sugar hit in the short run. And so the real question is what's going to happen later on. But before we move on to that, let's get back to bond yields rising because the market assumes that these policies will be inflationary. Now, if that turns out to be the case, which I think it will, what is the Fed going to do about it? So we get back to this issue.
Yes, and the Fed, question marks over the appropriateness of their 50 basis point cut to start the cycle. And now when you consider that in the light of the change in administration as well.
Yeah, well, I think some of them will be thinking, why have we gone down as much as we have? They've gone down by 0.75% so far. But that's going to be a very big story going forward. As I've already said that Powell can't be removed until the middle of 2026. It turns out that only one other member of the Fed board is also up for re-election during the Trump term.
The immediate years ahead.
Yeah,
right.
So it's not going to be possible to stack the Fed board with Trump appointees. And anyway, it's a very complicated situation. And there's actually a very good article on it this morning in the Sydney Morning Herald by Stephen Bartholomew, if anyone wants to follow that up.
So you're backing Powell to be able to see out his term, but probably having to adopt a position where they're going to be pretty cautious on rates given they know this inflationary environment?
Yes, I think there's no doubt at more than at the margin, it has changed the likely path of US interest rates, I think. And there's no doubt, I think, that over the next 4 years, interest rates and inflation will be higher in the US than we were formerly thinking.
Maybe we start to think out in terms of the longer term consequences if we can. You're sort of setting a scene here where things potentially begin to get into a more dangerous territory.
Yeah, I think there's no doubt that these policies pose a huge risk to the long-term stability of the world economy. Most of the people who think along these lines tend to concentrate on the dangers of a trade war, which of course could easily erupt as other countries retaliate against the US tariffs in order to protect their own domestic industries. And this sort of reminds me, if you're interested in history, of a previous episode where this happened in the 1930s, early 1930s, when the US introduced what we call the Smoot-Hawley tariffs.
Right.
And this led to retaliation by other countries, and was one of the things that increased the depth of the depression. Once again, a US initiative which spread throughout the world.
Sought to protect their own economy in hard times, but created compounding problems.
Yeah. The other thing, whilst we're on trade, the thing about a tariff is it is actually a tax. It's a tax on imports. And it's a tax which ultimately has to be paid for by the US public who import those goods.
By the end consumer who buys it.
Yes, yes. Yeah. That's who pays it in the end. That's number one. And number two, it's not just imports that go up in price. Let's take a simple example, cars. The US imports a lot of cars. They also manufacture a lot of cars.
Yep.
So if the imported cars go up in price by 20%, the domestic manufacturers of cars are able to put their price up by 20% and still maintain the same competitive position as they had before. Now, they may not choose to go
all that way,
but the thing is, their profit per vehicle is going to rise massively at the same time as the consumers'
the
cost of buying a vehicle is going to rise massively. And so if you think about that, that's really going to spread inflation through the economy reasonably quickly if they achieve those tariffs. And my understanding is that Trump does not need congressional approval. He can increase tariffs if he wishes.
On executive orders.
Yeah. So
the question, I guess, will be to what extent he chooses to follow through on something.
I know that's right. There's going to be a huge amount of lobbying too, for exceptions. Anyhow, look. So that's the first thing that people worry about, which is the trade war. But that's not my main concern. My main concern is on the pure macroeconomics of it.
The budget deficit.
Well, the starting point is the US economy is actually growing quite quickly. It's probably growing faster than any of the other developed countries. You wouldn't know that from the election result, but it is actually. And it's at full capacity with unemployment rate at a very low level. And its financial markets, particularly its asset prices, are fully priced, if not overpriced, particularly the share market. And finally, we're starting with a budget deficit of already 6.5% of GDP, and which is projected to rise even under existing policies, even before the Trump policies are put on top of it.
With no appetite of seeming to bring it back into
neither side talks about that anymore. So I think with a starting point like this, I can't imagine any responsible economic advisor saying what we now need is a big monetary and fiscal stimulus. But that's what we're going to get. Well, my fear...
Does that spell disaster?
Well, I think it has to lead to rising inflation.
Yep.
And, of course, the trade war going on in the background. And at first, some people will welcome this because, again, the sugar hit will be nice in the short run. But if inflation takes off, as I think it will, interest rates will rise. Either the Fed will put interest rates up to combat the rising inflation, or if for some reason they weren't able to do that, the market will push bond yields up. I mean, bond rates are not determined directly by the Fed. They're determined by the market. And the biggest influence on bond rates is expected inflation.
So at some point the market sort of fights back, a la, like the Liz Truss scenario in the UK, where the market just one day just went enough is enough.
Yeah, or in the 70s, in most countries in the 70s, bond yields rose faster than short-term rates. And I think that will be the situation. And so really what I'm looking at that I fear is short run, people think things are great. Asset prices, particularly shares and property prices and all these other things that the prices of companies that are traded by the private equity firms, all these sort of things go up further. And then eventually when inflation comes up and interest rates go up, they then crash. And I think that is a very distinct possibility. More than a possibility, I think it's a probability. But you may say, well, I have to concede, I'm looking ahead 4 years, 5 years.
We're not talking the next 6 months.
And that's a very hazardous exercise. But I want to remind you, big things do happen. Even if we have trouble putting them into our expectation that something big will happen, they do happen. And I think, even though what I'm saying might be thought of speculative, things as big as that do happen, and they've happened before, and not just once. If I go back through my working career, I can identify, which is about 50 years, I can identify 5 clear examples of where something of this magnitude happened. The first one was in about 1974, with the first wave of inflation and the recession that followed that. The second one was in 1982. This was the second wave of US inflation, which is referred to as the Volcker disinflation, which led to a big recession. And there was another one in the mid-80s. We had it here, with a big asset price boom and bust, and we had a recession.
87.
The one that people refer to as
recession.
the recession we had to have. Then in 2000, we had the dot-com crash. It was a US event, dot-com boom and then crash, followed by a recession. And then in 2008, we had the GFC. Now, I haven't included COVID in my list because that was not an economic, was not caused by economic events.
With an economic stress and then this stimulus cannon response as well.
It was caused by, it caused economic stress, but it wasn't economic events that caused it initially. We all know what it was. So there's 5 occasions where events as big as what I'm now predicting have happened in the last 50 years.
Is there something that can help it not play out as much that way? And would that only be a case where we see much more restraint on a fiscal policy side in the States, which you are sort of giving up hope of?
Yeah, I am sort of at the moment giving up hope of that. But the other thing I want to remind you is that events that are purely domestic American events can affect the world economy.
No doubt. Yeah.
The last 2 of those episodes that are referred to, the dot-com crash and the GFC, they were caused by the US economy, caused by excesses in the US economy. No one else caused them. It was entirely the US economy that caused them. So it's not surprising that you would worry that a third event caused by excesses in the US economy could cause something of that order of magnitude.
Well, we know asset prices are certainly correlated across regions, and not perfectly correlated. They certainly have a lot of linkages. Let's actually explore that a little bit further if we can. So you're sort of setting a scenario there of where, unless there's a different path taken, the US could get into a position of quite a bit of excess and risk, albeit medium term. How do you see Australia positioned in all of this?
Everyone will be affected in the scenario that I'm describing. The direct effect from the tariffs on Australia would be small. We don't export much to the US. It's only 4% of our exports.
Indirectly?
But indirectly, the effect on us would come via China. If they really do put a 60% tariff on Chinese exports to the US,
across
that would
the
really
board.
crush it. It would really have a severe contractionary effect on the Chinese economy. And therefore, that would have a severe effect on our exports to China, particularly our exports of raw materials to China. So we would indirectly participate. On the second channel, the inflationary channel, we would end up participating. Why would we end up participating? Well, we tend to think of inflation as being a domestic event. We look at our own CPI and we think, well, and the solution to that is a domestic thing, you tighten monetary policy. But if you look around the world, the big waves of inflation have been highly correlated amongst all countries. In fact, just even look over the last decade or so, all the developed countries had very low inflation from about 2010 to 2021. And then they had, as we recovered from COVID, a sudden jump in inflation.
Across the world.
And across the world. And then it came down again very quickly. Now, it hasn't come back to exactly where it started, but this inverted V is common to all countries. And so inflation is highly correlated, just like business cycles and recessions, they're highly correlated around the world economy. And so there wouldn't be any way that we could avoid it completely, although we have done a very good job in recent years in that we avoided the dot-com crash of 2000 leading to a recession, and we avoided the GFC of 2008 leading to a recession. So we have done very well.
Official recession, yeah.
We have done very well, but normally, but we weren't totally unscathed.
Well, the asset prices here were very much impacted, as much, if not more, than the US.
Yes. And the economy did slow. We just didn't slow to the extent that we had a recession.
A formal recession. Maybe we could step across then when thinking about Australia and the outlook and the potential implication for inflation finding its way to our shores. How do you think, in terms of where we sit today, in terms of the interest rate outlook?
Well, it has to have caused an upward adjustment to the likely path of Australian interest rates. Doesn't necessarily mean they're going to go up, certainly not in the short run.
Do you mean that our neutral rate, whatever that may be, is now possibly slightly higher than what it might have been?
I don't want to really get into the neutral rate.
I'm not going to ask you for a figure, just hypothetically.
You can tell the story without even having to think about the neutral rate, because the inflation effect on interest rates would be very pronounced in the scenario that I'm looking at. And so interest rates would either come down by less in the short run, if at all, and in the long run, I think they would, in this scenario, they would go up. I don't think there's any way that we could avoid that. Now, people may say I'm a bit of a pessimist on this. As you know, who people have been listening to this before, I never believed that interest rates were going to come down in 2022, 2023 or 2024, although the market did. The market was always pricing in a fall. I never believed that would happen, and it hasn't happened. So I've probably got a track record of being very sceptical of
conservative
falls in interest rates. Now, that doesn't mean I'm talking about Australia here. It doesn't mean it doesn't mean I thought that the US would never bring interest rates. I was pretty confident they would. Although, as I think you alluded to, looking back, they must be wondering why do we have a 50 and then a 25 so quickly when the world changed within a couple of days after we did it.
So you would be in the camp now of interest rate probably an adjustment in 2025, but no guarantees, is that?
Well, that's right. I mean, I think I probably would have been in that camp of, yes, about time, by sometime in 2025, if inflation continues. Well, it's actually coming down. It's hardly coming down at all around the world. It's had this big fall, and it's sort of either creeping down or just flat at about 3, or in the US maybe just under 3.
High twos,
high above 3. It's sort of, you could make the case that it's sort of stuck there. But
and in that scenario, if inflation seems to be stuck there and our unemployment rate is not too terrible, well, what grounds do you have for cutting it all?
Well, that's right. I mean, there never was, certainly in Australia's case, there was never a strong case, because we weren't starting from a point of high interest rates. We were starting from a point of interest rates being below average by historical standards. And we didn't have the usual reason for cutting interest rates is the economy is tanking, and that's going to push inflation down a lot and unemployment up a lot. We didn't have those. We haven't had those conditions. So the argument for a cut in interest rates in Australia was always pretty weak. And it may still happen in 2025, but there's no question that at the margin, anyone whose job is to set interest rates has had a reality check and have thought, well, whatever the path was likely to be before, it's probably going to be higher now.
Well, what about the overlap between, we talked about the overlap between politics and the central bank in the US, and here we're not completely immune for some of those political calls.
Oh, I think we're...
Particularly with an election on the horizon.
Yeah, there's always some sort of tension between the elected government and the central bank. There's always some tension. I think we've handled it very well since we instituted central bank independence in 1996. The government has got a right to tell the central bank what they think. And in fact, even to go public and say, I think the central bank's wrong. So even in my time, John Howard on several occasions said he didn't agree with what we had done. And at that stage, that didn't worry me at all. Because
you kept him on the Christmas card list? Are you still on the Christmas card list?
Yeah, I was on his Christmas card list, yeah. It didn't worry me because it really established in the public's mind that it was the Reserve Bank's monetary policy, not the government's monetary policy. And we were still struggling to get public acceptance of the fact there was an independent central bank.
Independence and separation.
So it actually helped us.
Okay.
So it's not out of the... I mean, you can't... Central bank independence really means that the central bank makes a final decision. But everyone in the community, from the dustman up to the Prime Minister, has got a right to give their opinion of what they think should be done. I think... Chalmers has been reasonably restrained, although he did make a big mistake when he came out with that statement that the Reserve Bank was smashing the economy. I don't think anyone really believed 4.35% interest rates were smashing an economy. They still had an unemployment rate of 4 point something. So I think he overstepped the mark a little bit there, which he had a right to do if he wanted to, but I don't think it helped him at all.
Anything else on your mind?
Well, I think I've said some pretty outspoken things so far, so I don't think I can really add any more to it, but I do feel if I was a forecaster, I would be very worried about these things. And if I can add a final comment, I note that Warren Buffett has been selling shares and boosting his holdings of cash in his portfolio. And I think his holdings of cash are higher than they've ever been.
Back at GFC levels, certainly.
Right.
Yeah.
So I think that's gives me some comfort that there are other people who I admire, who are at least thinking along the same lines as me. And by the way, he started doing that before the election.
Yes.
He started doing it on the basis that he thought that all the assets he looked around, he was thinking of buying, were already overpriced.
Yeah, very large position in Apple, which he's been, trimming down over about a year or so. And he's typically been on the cautious side and been right many times. So many valuable insights, words of wisdom. Thank you, Ian. Thank you for your contribution.
Thank you very much, Vincent.
And thank you to all our listeners.